Hey guys, this is Mr. Breen, and in this video I'll be talking about long-term economic growth. Alright, so at this point you know that the business cycle looks like this with expansion, peak, contraction, trough, and then the cycle starts over. Expansion, peak, contraction, trough. And this is GDP over time again. And so let's just say that each of these little intervals is 1 year. Okay, so this is a fairly short-term outlook. But if we zoom out from this graph, and instead each of these intervals represents a decade, these things are going to be smoothed out, and instead we're going to have more of an upward line like that. Now it's not as smoothly upward as all this, but this is just, me trying to demonstrate to you that over the long term, generally speaking, despite these short-term fluctuations, usually we have long-term growth. But what causes that long-term growth? Well, let's use a production possibilities curve to show what this looks like. So let's just say wants and needs. We could say anything. We could say consumer goods and capital goods, or we could say military goods and consumer goods, or something like that. But whatever we say, we put on these axes, this is going to represent our maximum level of production. And growth means that we produce more. We are able to produce more. So what leads to that growth? Well, what caused us to be able to produce this amount in the in the first place? And the answer is factors of production. The more factors of production we have, the more we'll be able to produce. It's as simple as that. Now, our factors of production, as you know, are land, natural resources, that is, labor, time and effort you spend on something, physical capital, okay, the tools that you use to produce things, and human capital, the skills and knowledge you need to produce those things. But what we're really interested in here is not just GDP. No, what we're interested in is real GDP per capita, per person. So that means that we can actually eliminate labor as a cause of economic growth in some ways, because we can't actually grow on a per-person basis just by adding more people. Every time you're adding to the numerator, you would also be adding to the denominator, so the actual total of per-person output would not go up. What that means is we need more land, but this isn't really human-created, so that's going to pose a problem. What we really need is more physical capital and more human capital. So let's go back to a model that we were looking at before, where we looked at a person's income, and we said, look, if this pie represents a person's income, then a big chunk of it might be consumption. So that's how much you spend on stuff that you're going to consume today, and some other chunk of it might be saving. Now, we know that saving is basically equivalent to investment, as long as you put it in the bank or put it in a mutual fund or something like that. And this investment gets turned into capital, right? Because it gets lent out to businesses to invest in things, or it gets lent out to students to go to college and increase the amount of human capital that they have. So investment gets turned into capital. And capital is basically almost entirely comes from investment. In another way of thinking, all capital expenditures, all capital purchases are not consumption and therefore are saving, because if you're purchasing capital, by definition, you're purchasing something that you're not intending to consume today. Instead, you're intending to use it to increase your income in the future. Okay, now let's also say that there's some amount of capital stock in the country, and this bar will represent our capital stock. Maybe that's $100 billion worth of capital. Now, every year we're going to add to this capital stock roughly by the amount of savings. Okay, so we're hoping to increase the amount of this capital stock by saving some money, let's say $10 billion. But there's also going to be some depreciation, because capital loses value over time. So, the machines that you buy, eventually they do break down. Maybe it'll last for 30 years, but it's not going to last forever. So depreciation maybe, and we'll put it in good Michigan State green there. It's depreciation, of course, Michigan State. And let's say our depreciation is $5 billion. Okay, if these things are true, then our capital stock next year is going to be it's going to be higher by 10 billion, lower by 5 billion. So next year our capital stock is $105 billion. So as long as our population didn't grow by more than 5%, right, in which case we'll still have the same amount of capital per person, as long as that's not true, we'll be able to produce more per person next year than we did this year. So where does this long-term growth come? Well, to make a long story short, it comes from saving. Okay, another way of putting this is that each person is supported by a certain amount of physical and human capital. So let's say it's this. This is your stock of physical and human capital. Okay, and growth means having more capital per person. So now we're supported by this much capital, and everybody's a little bit more productive, and therefore real GDP per capita goes up. This process is called capital deepening. So where does all this saving come from? Well, a lot of it's going to be private saving, right? Just in the bank or in mutual funds, or pension funds or something like that. Okay. But also it can come from the government. If the government taxes people, they're going to reduce the amount that regular people save. That's true. But if they spend that much on infrastructure, things like roads and ports and airports and stuff like that, well, that's saving as well. That's capital deepening. Infrastructure is physical capital. So that helps. And there are also sovereign wealth funds and public pension funds. So many companies or many countries actually have sort of, you might think of them as like mutual funds that are managed by the government for a variety of purposes. And so they can also contribute to savings in this way. Okay, or they'll have just public pension funds. So maybe something like Social Security, except this is not, there's no pension fund for Social Security. But they might just have a pension fund that they operate like a mutual fund or like a private pension fund. And there's also foreign investment, which is very, very important for especially developing economies who don't really have the resources for domestic private saving or for domestic government spending. Instead, they're going to have to rely on foreign investors to come in and build human capital and build physical capital and invest in human capital in their country. Now, all of this saving needs to fund stuff that is actually useful for production. So, for example, education, like college or K through 12 education, which hopefully will improve people's productivity. It also should improve things like, as mentioned, infrastructure, roads and ports and airports, without which it would be much less profitable to produce stuff, or just regular old business investment like factories and stuff like that. Now, we're not asking the government to build factories. That's not the way it works, right? But businesses need to have access to investment funds to build those factories and also to finance technology. Okay, in a variety of ways. So the government helps by protecting patents for new inventions, but also by providing money for research grants for basic research, so that our technology level can improve and our physical capital and stuff like that is actually more effective, even if it doesn't go up in amount.